We think the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case. When that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now.
Cathie Wood outlines a rapidly evolving macroeconomic landscape where traditional finance is on the edge of transformation. With inflation decelerating and interest rate cuts looming, Wood highlights an inflection point that could ignite a new phase of economic expansion driven by innovation and digital assets. As Powell's Fed tightens policy into a slowing economy, market volatility surges, but Wood sees through the noise. She argues that this tightening cycle is nearing its end, and the next phase will favor high-productivity sectors and disruptive technologies. For crypto investors, this sets the stage for Bitcoin and Ethereum to emerge not just as speculative bets, but as critical monetary assets in a digitized economy. As institutional capital waits for clarity, the convergence of fiscal policy, technology adoption, and capital market realignment places crypto at the center of the coming economic recovery. This is no ordinary pivot, it's a systemic reboot with digital assets leading the way.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
And one of the big variables that many people are wondering about now is interest rates. This week, Chairman Powell sounded very hawkish. I think he didn't appreciate being featured along with President Trump at a construction site. So there may have been something else going on there, because the data as it is evolving here is certainly moving in a direction that would lead the Fed to ease. And of course, for the first time since 1993, there were two dissents on the Fed board this time around. And that suggests that we probably are going to see interest rate cuts in the future. I think the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. I know the headlines were blaring worst dollar start to the year, our worst first half since, I think, 1993, if I'm not mistaken, which, by the way, was the last time 2 Fed directors had dissented from the policy being made. So you can see that all of that drama put in context was a little exaggerated, shall we say. And if you look at the next chart, I did present it for the first time last month, you can see here that the uptrend has not been broken. And if we're right on return on invested capital, it will resume its increase relative to the 26 countries in this index. Inflation, as measured by commodities, it is kind of shocking still that tariffs notwithstanding, it's today where it was in the early 90s and in the early 80s. Here's the S&P price to gold. This we're paying a lot of attention to because some of the best strategists out there, our friends at GovCal, have been suggesting that we were going to spiral down into a 70s environment with tariffs causing inflation and so forth. The market's been weighing that risk, as you can see here. The most recent move, however, in this index has been up, and we think it will resume as we get through this uncertainty, especially the uncertainty around recession and the Fed. Here, relative to oil, we think this is a leading indicator of what will happen, and it looks nothing like it did in the 70s. Here, I always like to keep this chart in mind. I started my career really near the peak of this interest rates, and have been riding down the curve throughout my career, which was delightful. But you can see there's a downtrend, which is good up to a point. What did near 0% Treasury yields mean? It meant, in the case of COVID, are we going into a deflationary bust? And we got out of that. And maybe we have just bounced back to something more normal now that the Fed is letting markets work. We do think that the Fed is actually erring a bit in the other direction, as I mentioned before, and that will change. And with it, we do think interest rates along the entire yield curve will come down. And here's Bitcoin to gold. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case. When that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now. So with that, I know a lot of puts and takes, a lot of charts, but it was a busy day for sure in the markets, a lot of fear surfacing once again, and yet the way we're interpreting this is another indication that the market is climbing a wall of worry. And we need these shudders every once in a while to keep speculation in check. And we think that's just another one of those checks.
Wood dissects the current macro environment with precision. She emphasizes that the Fed's policy remains too tight, confirmed by inverted yield curves and weak private domestic final sales. Yet, inflation is slowing and commodity indices are back to 1980s levels, signaling deflationary trends. In this environment, Bitcoin stands out. Its chart against gold shows an unbroken uptrend, suggesting capital is flowing into it as a safe haven, not away from it. Ethereum and smart contract platforms like Solana remain vital but serve different purposes, acting as decentralized infrastructure for the digital economy. Wood expects rate cuts beginning in September, with real estate and capital spending set to rebound as borrowing becomes cheaper. These shifts will unleash the next leg of growth, driven by technology, high-productivity sectors, and decentralized systems. Bitcoin's role as engineered monetary capital will gain institutional validation as the market climbs this wall of worry. Crypto is no longer fringe, it's becoming foundational.
As I mentioned, Chairman Powell sounded quite hawkish, even though reporters were saying, well, wait a minute, housing seems to be relapsing. And he deflected that. And, well, wait a minute, the metrics you look at in terms of core growth and core inflation, they're all moving in the right direction when it comes to inflation, and actually in the wrong direction when it comes to GDP growth. I think I'm not going to get the metric exactly right, but what Chairman Powell focuses on is real private domestic final sales, and that is running in the 1% range. And we saw that with the consumption figures, very slow. The consumer is becoming quite cautious and beginning to lift the savings rate. We think that could cross 5% this year. But you see, money growth did start turning around. It was negative for quite a while. We're now up to roughly 5%. But when you get cautious consumers, that means the velocity of money, the rate at which it turns over, slows down. So the stimulative effect just isn't going to be there the way that this chart might suggest. We also know that the CPI, which is depicted in the green here, faces some tough comparisons. So I think we have two more tough comparisons at the 0 and 0.1% rate for the next couple of months. So the inflation rate could stabilize here, and maybe that's what Powell was responding to, just knowing that the optics aren't going to look great on inflation, meaning continued progress. But if we're right, that will be it. Then we're off to another leg down in inflation towards the 2% and actually below the 2% range if we are right. Now, of course, we have been expecting much lower inflation for quite some time. Tariffs are complicating the situation perhaps a bit right now. But there are metrics out there. Oh, well, before I go on to inflation, let me just depict Fed policy here. This is the 2-year Treasury yield less the 3-month Treasury yield. And when it is below zero, which it is here and has been for quite some time, monetary policy is restrictive. You can see every time this has happened before, we end up in a recession. And, we're very lucky we haven't ended up in a full-blown recession. It's been more of the rolling variety. But we do think, because of how long this has taken place, the Fed jacked rates up in 22, so it's been 3 years, that a lot of rubber bands are stretching, particularly in the housing and capital spending markets. The housing needs lower rates and or lower prices, and we are starting to see lower prices moving affordability up slightly. I think lower interest rates will really get it going in the next 6 months. And capital spending, now we have certainty with this tax package. And I think those two sectors are very high multiplier sectors. In other words, $1 spent on housing causes all other kinds of spending to take place. When you move into a new home, you're buying lots of stuff. And the same with capital spending. Lots of follow-on from $1 spent on capital expenditures. So we do think the Fed's too tight. This chart is reinforcing it. We're starting to see a little progress. We've seen a relapse, and we do think it might mean that in September we'll see a 50 basis point cut, and perhaps for the rest of the year, 75 basis points when all is said and done, especially now that employment is showing such weakness.
As fear grips the market and economic data creates confusion, Cathie Wood reminds us that volatility often masks opportunity. With the Fed poised to reverse course and the dollar under pressure, the crypto market, especially Bitcoin, stands to benefit disproportionately. Wood envisions a near future where inflation overshoots turn into undershoots, interest rates fall, and productivity-driven innovation powers the next expansion. Bitcoin will not just outperform, it will redefine capital preservation in a world where fiat weakens and traditional stores of value like real estate and bonds falter. Ethereum and other decentralized platforms will enable global economic efficiencies that central banks and governments can't replicate. The next 12 months may see the transformation of fear into conviction, where forward-looking investors recognize crypto not as risk, but as a hedge against systemic failure. For Wood, crypto is not speculative noise, it's structural signal. The future isn't coming, it's already here, and it's being built on-chain.